Hey traders, this is Blake Morrow with Trader Summit, and it is Friday. So, of course, I have Mr. Jim Welsh with us from Macro Tides. He's going to break down. Oh, Jim, come on, tell us why again we are at all-time highs in the equity markets. Was it the CPI? Was it the producer prices? Was it the NFP beat last week? What is it, Jim?
Well, there's really been no real reason to sell.
Yeah.
I mean, we use a lot of technical analysis, and it's very, very helpful. I think it has to be used in conjunction with fundamental analysis. But one of the things a lot of technicians don't, I think, fully appreciate or understand, that technical indicators can show that momentum is waning, there's divergences, all that stuff, more often than not, leads to subsequent price weakness. And the degree of that weakness is largely determined by the strength of the reason to sell. If it's no big deal, you go down 3 to 5% in the S&P. You get a big reason to sell, like a recession, then you're at 25 to 30%. So I think the main thing is that the bullish narrative is still holding intact, in the sense that we don't have to worry about a recession. Earnings are going to keep growing. And to top it off, the Fed's going to be cutting rates. We can dicker about how fast and how much, but the bottom line is they're going to be cutting rates. And I think that's been the underpinning that has kept selling pressure extremely low. And then lastly, we're seeing another resurgence in terms of the semiconductor stocks, NVIDIA. The weightings that they have been very helpful. And so it's just a confluence of things, but I'd say the overriding reason is have no reason to be a real seller. And that's why the buy the dip mentality has flourished.
Yeah, and you have this huge rally in stocks. Pullbacks have been minor, so I'm assuming we should respect that. But I know you brought a lot of charts this week that might give us a little bit different picture. So I'm excited to get into that stuff with you, Jim. So let's just
Cool.
let's dig into it. Let me grab
Yeah,
your
one of
first.
the things, the last week's jobs report, it was a solid report. If you look at the number of jobs, 250 and change, 100,000 more than what was expected. Unemployment rate ticked down from 4.2 to 4.1. Wages up 0.44% annually. All good numbers. What I found, though, when I dug a little bit deeper last Friday, Blake, and I did some tweeting about it, and then I wrote about it in Monday's weekly technical review, is the household survey is the one that dictates the unemployment rate. So in the household survey, another good number on the surface, up 430,000. You and I have talked how over the last year, fairly consistently, the household survey was weaker than the headline number that we all read from the establishment survey. And part of it is that the establishment survey counts part-time jobs. Somebody has 2 part-time jobs, you're going to be counted twice in that survey. They don't do that in the household survey. So one of the things that all economic statistics that the government publishes, and this is not sinister in any way, is seasonal adjustments. And if you think about it, at Christmas time, most retailers get almost 25% of their sales happen during the holiday season. Then comes January and sales fall off a cliff. So what seasonal adjustments attempts to do is to smooth out these crazy fluctuations that happen every single year. And the same thing happens in September when kids go back to school and teachers go back to school. And, kids are in high school, juniors and seniors, as well as college kids who have a summertime job. Well, they quit their job and then they go back to school. So you see every year this huge shift in terms of job increases and decreases and so forth. So they try to seasonally adjust it. So what this table shows is going back to how many government jobs are there, federal government jobs. And it's 22,310,000 like in 2017, in August, and then September, how many, and then seasonal adjustment. And what's the net change? And what we can see is 2017, 18, 19, 21. I skipped 20 for obvious reasons, the pandemic. And then 22, you can see the seasonal adjustments have been very effective at smoothing out all this crazy things with just really modest changes. Last year was 50,000. Well, this year in September, 785,000 government jobs were created in the month of September. Now, you'd have to be born yesterday to believe that. And what does that mean? Well, if the seasonal adjustment had been similar to what we've seen in the prior 6 years, the unemployment rate wouldn't have gone down from 4.2 to 4.1. It would have gone up from 4.2 to 4.3. So, this is such an outlier of a number, Blake, that, and it's happening 1 month before an election. I'm sorry. I'm not a conspiracy type
Where's
of guy.
my tinfoil hat? Where is my tinfoil hat?
Yeah, right. Houston, have we completed the moon landing yet? Yeah, we got it all in the studio. So again, I'm just looking at this and like, wow, this is such an outlier. So instead of 430,000 jobs, if you take away most of the, let's say it was 85,000, okay, this year. Well, okay, fine. That's an improvement from last year. But you'd subtract 700,000 from 430, guess what? You'd be down 270,000 jobs. And what would then the impact would have been on the unemployment rate? It would have, in all likelihood, ticked up instead of down. So, we live in, again, you and I have talked about this. My biggest, I think that frightens me the most is the lying that is being done by both political parties. Both of them. Now, the left thinks only the right lies and the right thinks only the left lies, but the reality is they both lie, and the lying has become epidemic. And to me, what that, and the media is in fact playing a role in some of this stuff. That is the thing that scares me most in terms of where our country is headed. And so I'm, again, was this intentional? I have absolutely no idea. But from a statistical standpoint, it's a real anomaly.
Well,
So,
look, Jim, I agree with you. This is something that I've been talking about with in our community over the course of the last week. But you really put your thought into why and how this could really happen. So I applaud you for that. Hey, let's move along to the CPI data.
Yeah.
So what do you make of this CPI? It does seem like we're basing, right?
Well, they're not making the kind of progress, obviously, we have in the past. And, the core CPI up where it is quite a bit above the Fed's target. Now, the Fed puts more weight on the core PCE, which is under 3% and so forth. But my only point is the economy's been growing at 2.5% to 3%, and the Fed is cutting interest rates. And, the point I would make is that, people are like, oh, maybe the Fed won't cut in November. I think, there's actually a percentage. I don't know if it's 25% in the Fed funds future saying, oh, no cut in November. Bostic yesterday gave a speech. He'd be comfortable not cutting in November. I just think the odds, Blake, are that they'll go 25 basis points, because not going 25 basis points would make it look like the 50 basis point cut was a big mistake. And
Was it?
It was a really, really close call. I've written about it. You and I've talked about it. If you looked at it, the minutes that came out on Wednesday showed, yes, indeed, there were 2 or 3 people that went along with the 50 basis point cut. There was one dissenting vote, first time since 2005 that's happened. So I just think that the odds are that they'll go with the 25 basis point cut in November, and just because they're going to get more and more data before the December meeting. So inflation being a little more sticky, I don't think completely dissuades them from doing that. And at the same time, the employment numbers and so forth, they're not completely stupid. They look at stuff, and I think they'll see through some of the strength that we saw. The work week in September declined by 1/10.
Yeah.
If you look at the ISM services, their employment measure dropped below 50. So again, there's signs out there that, you know what, labor market still is softening. And I think that's what's driving the discussion and why I think the Fed will go 25 in November.
All right. Well, the next slide you brought out is regarding Milton, and for those of you that are currently dealing with that, good luck with the cleanup, and hopefully you and your family are fine. And it could have been worse, right? The storm was a Category 5. I think by the time it reached land, it's a Category 3. But still, I mean, that's nothing to just whiff at, but it was still a pretty bad storm. But what are you looking at here?
Well, this is data from Helen, which was over 2 weeks ago. Okay. Yep. So Bank of America can look at charging credit card transactions and so forth. And the is the credit card activity in Florida, Georgia, North Carolina, South Carolina, and Tennessee. These are the states that were most impacted by Helene, especially obviously North Carolina that we know. So, credit card spending dropped a lot in response to that hurricane. We're going to see the same thing. Historically, what the numbers kind of show is that you see this weakness due to the hurricanes or natural crisis, disaster type things. But ultimately, you wind up getting more spending because people have to replace what they lost.
Yeah.
Whether it's paid by the insurance company or out of their own pocket. So my only point is the numbers that we're going to be looking at are going to be distorted. Yesterday, the unemployment claims had a big jump, and continuing claims, I think, were up close to 50,000. And so people, oh my God. Well, wait a second. That's from distortions from Helene. And so it's going to be more challenging to really decipher. And a couple of weeks ago, I showed a chart showing continuing claims. And as you get past mid-October, the last 5 years, continuing claims have ticked higher, like through November in a fairly meaningful. It's the seasonal pattern. And, the hurricanes are likely to magnify that increase. And again, it just makes it more difficult. What's the real signal here?
Yeah.
And so I'm just basically raising this, is that when we get some headlines and some people jump on the bandwagon, oh my God, look at the unemployment claims went up, like I heard yesterday, or we get credit cards.
Were you sitting in my office?
No.
Okay.
But I mean, the thing is, we all have to keep our eyes open, our head on a swivel.
Sure.
And in these kind of environment that so many people are impacted. Now, in some respects, Milton may have less of an impact since it was so concentrated on one state, as opposed to Helene, which affected many more millions of people. But either way, the disruptions are going to be there.
Well, let's talk about how it's affecting markets. And you brought a couple charts here with the S&P, and explain what this is. I mean, we are at all-time highs, and I don't think we can argue that, right?
That's what the numbers are showing, man. Facts are facts. So this intermediate trend is a proprietary indicator I put together about 5 years ago, something like that. And what it looks at is the 5-day exponential moving average and 21-day exponential average of advances minus declines, new highs minus new lows, up and down volume. All right. So it's like, for me, it was like the ultimate breadth indicator, because I'm combining all the components of market breadth. And when the 5 days on all three of those measures are above the 21-day, you get positive numbers and that thing goes up. It aligns with the trend in the S&P pretty well over time. Now, what we saw in June is the alignment kind of didn't work real well. Well, what do we know about June? Well, we know that the semiconductor stocks, NVIDIA, going into July, were just exploding. And so you had this concentration of mega cap stocks lifting the S&P while the majority of breadth indicators were weakening. So my point in bringing this up, Blake, is that we all use various indicators that have a degree of reliability, but they're never perfect. And this is an example of, over the last 2-3 weeks, I've been looking for a period of a pullback. This was one of the reasons, because the S&P kept making, holding sideways while this is going down. Well, why? Well, because the number of stocks making new highs was contracting significantly. Breadth was fairly weak over the last week or so. Up and down volume were also not very supportive. So, again, momentum indicators are really helpful, but they have, weaknesses like every indicator. And the next chart, just taking this a step further.
I'll get there one second, just clearing everything out here.
Moving.
Here we go. There we go.
There you are. Okay. So, I talked about a target on the S&P of 57.25, 57.43. So we basically got to it, tiny little bit above, and we see this weakness under the surface. As at the bottom panel is the RSI. So you can see, gee, the S&P made new highs relative to August, but the RSI was lower. These are all classic indicators, right? In terms of, okay, momentum is weakening, but we didn't see a reason to sell. And the last piece I wanted to highlight is, I've talked about this frequently, is the 5-day exponential versus the 13-day exponential moving average. And what you can see, the 5 days in the red. Well, when the red's above the green, that's a positive trend signal. So these momentum indicators warn of price weakness, but ultimately you need price to confirm. And in what we've seen the last 2 weeks, despite signals from indicators that more often than not are very helpful to identify periods of weakness in the market, the trend remained positive because the 5-day stayed above the 13-day. And so that's why, to me, I try to use a number of indicators. Some are, if you will, precede changes in the market, but then sometimes they misfire. And this was an example of one. So I just thought, you know what? The market hasn't done what I thought. At the same time, using these kind of tools help. Now, yeah. I'll just share with you, I've been short twice the last 2 weeks. I bought SH, which is the 1-to-1 inverse S&P. And on those 2 trades, I lost 1 penny on SH. So, and it's trading around $10.80 some cents or so. Again, why? Well, because I was respectful of this 513, despite the warning from these other signals. And then, of course, I use, 30-minute charts, 10-minute charts, all that craziness. You try to catch a turning point by using shorter time frame charts, but then ultimately the daily stuff has to, support you. So I'm going to carry this theme through. Whoa.
That's your SH.
Yeah, there's SH. Yeah. So, and is that the 5 and 13 on it, or do you got something else on there?
No, but it's a 50 and 200 DMA. Yeah. So, or moving averages. That's fine. So this is your 4
hour. No, my only point is that, my bias was we were going to see a pullback. The depth of that pullback to me was, okay, we'll see what kind of reason shows up. Short-term charts were, when they turned negative towards the S&P, I went short. And as soon as we didn't hold the prior lows, I was out. Fortunately, the times I got in were relatively close to the prior lows. So anyway.
Well, definitely worth noting that you're trying to play it, but it's just, you're waiting for price to really confirm your moves.
And then at that point in time, you add the position. So again, the early warning indicators were saying, hey, we're getting set up for a pullback. Is it going to be a 2% pullback or a 5% pullback? That's always going to be dependent on how strong the reason to sell is. And what we've seen is the data has come in, the CPI came in. Oh, yeah, a little weaker. Is it going to dissuade the Fed? No. The Fed's still going to be cutting. And that's why I think it didn't have the kind of impact it would have had, let's say, 6 months ago.
Well, one of the reasons why that's carried this market higher is the semiconductors. So tell us a little bit about this chart, Jim.
Well, we talked about this, I think, a couple of weeks ago. So to me, it's like, okay, at the time I said, you know what, the pattern on this, well, again, I'm going to go back and review this kind of look, our little tutorial here. Back in July, you can see the RSI had a big divergence. Then the red line crossed below the green line. And ultimately, the semiconductor SMH dropped 29%. So here's an example of it working exceedingly well. The other point of view. Then from that low at 200, A, B, C up. And so to me, it was important that the semi stayed below that 255.99. Well, we poked our head above that by a small amount today. So again, this is another sign like saying, okay, this is a positive until proven otherwise. I thought the semiconductors were important to pay attention to. And to me, it looked like they were setting up for another decline. Well, that's been negated.
All right.
Doesn't mean they won't have a decline 2-3 weeks from now. But right here today, October 11th, it's like, okay, this new piece of information suggests we have, in terms of looking for a place to go short.
Yeah.
This is saying better be patient.
Well, you've been looking for a bounce in TLT, and we've continued to sell off as well. And yields are still really strong. I was just listening to another macro analyst yesterday that is just so bearish on the dollar and bullish on the bond market, thinking yields are going to go down and the bond market's going to rip. But that hasn't been the case yet.
No. We've seen really concerted selling. As I noted, 8 straight down days. That's unusual, all right? But one has to acknowledge that that's a high degree of selling pressure. Granted, now it's starting to get to where it's somewhat extreme. The RSI is comfortably below 30, so we're really oversold. But that kind of selling, Blake, typically doesn't just go way overnight. So what that implies to me is that somewhere in here, there will be a bounce of some magnitude, and then people who are negative will use that bounce to sell into, or people who are long and, oh my God, it's going against me. And so I just think that, that TLT has some bottoming and basing to do before we can really expect, a sustained move to the upside. And as I showed last week, the surprise index, economic surprise indicator that Citibank puts out, it's been moving higher. Well, guess what? It's, I thought, as I said, it's going to keep going up. It has. But that needs to kind of reverse, because what I showed last week was the surprise index gets up to a level, then the estimates for future numbers get raised, and then those numbers come in and they're softer than expected. And that's when we've seen treasury yields come down. So we've seen a combination of higher oil prices, data coming in, question about, well, gee, how aggressive is the Fed going to go another 50? To, well, gee, now there's some people talking about no cut in November. All of those things have been a real headwind for treasury bond prices. And, I could be wrong here, obviously, or more wrong in the sense of maybe the economy is never going to slow down. The deficit was confirmed 6.4% of GDP. That's a big number.
Yeah.
So that kind of
fiscal spending is just going to continue with the new president, whichever one it is.
Either way, either one. It's just how, like one of them will have a bigger deficit than the other, but both are going to have big deficits. Sure. And I do believe, and you and I have talked about this, the bigger picture in my mind is the treasury bonds sold off in 5 waves from their high of March of 2020 to the low last October. That said, we were going to get a rally phase. Well, we have. It may be over. But, I'm in the camp that I think this is a pullback and there's another push coming, because I think the economy is going to slow. But ultimately, I think the 10-year goes to 7.5% or higher.
Wow. That's
part
a
of it
big,
will be supply. Part of it will be supply.
Okay. All right. Big. That's a big, wow. Okay.
Oh, no,
well, what's that do to the dollar, Jim? I mean, because you got the dollar here, and we've had a really, it's kind of like the insatiable selling that we've seen in treasuries and TLT.
Right.
We have the same thing in the dollar. So is we got more oomph in the dollar? What do you think?
I think it's nearing an end. from a standpoint that, I had talked, for a couple of weeks, 102, above 102, maybe 102.50. So obviously it's gotten a little bit beyond that, where the RSI is up to 67. So it's getting somewhat overbought. Off to the left, you can see during July, there was some trading right around 103. We're there in that, resistance. There's overhead resistance, 103.65, one of the lows. I think we're getting close. I just think you can see some choppiness for a little window of time here, Blake. You can see the 5-day exponential is comfortably above the 13-day. So, I mean, it's almost like you go sideways. So those two moving averages can get closer. My expectation is we're going to see the dollar decline and drop below 100.
Okay. And we were just about down there. So hopefully, in your view, the dollar will eventually make its way back down there again.
Yes.
Okay.
Yeah. I mean, I think 95 ish is a target, sometime over the next 6 to 9 months. And again, where am I getting that? The dollar fell from 114 to 101. That's 13 points. The high last year, I can't remember what the month was around 107 and change. You take 13 from 107, and what do you get? You get 94. So that's where that number is coming from, that you had a 13 plus point decline, a rebound, C equal A, and that's where you get down there. So that's why I believe that we've had 1, 2, we're in the middle of wave 4 of wave 3. Another drop down below 100 to complete wave 3. There'll be another bounce, and then wave 5 will ultimately take the dollar down near 95.
There you go.
That's
something like this, like that, and then a big fall.
Yeah, it shouldn't take out this, whatever this high is. It's unlikely that the dollar would take out that high.
Okay, like this.
But you're still talking about a pretty good rally.
Yeah.
You drop to 98 and you rally to 102, 103-ish, or whatever it turns out to be. That's a pretty good move.
Well, that means gold is going to 3,000.
And it very well might. Now, the thing, I've talked about the positioning, which there's, the long positioning in gold has reached an extreme. That's not a precise timing tool, but it just tells you you're in a zip code of a high. The pattern I thought had completed when gold got to 23.84. But look at the decline. Looks like an A down, a little bounce, C. So the decline in gold has been very shallow. It held the uptrend. And what that and all this to me says, okay, you had an ABC down. Today's strength implies, not that this is forecasting a big move here, but gold should go to a new high, probably over 2,700.
Yeah.
And what we'll see, if it's a modest move above 2,700, call it 2,700 to 2,720, the RSI very well may diverge, and that will set up, a pullback. But we're not there yet. So,
all right.
So all these markets have kind of resisted, what I was expecting. In the bigger picture of things, I'm not sure it changes a lot, but in the short term, it certainly has.
Well, Jim, I want to always thank you for spending the time with us. And I know for those of you that appreciate Jim every week, make sure you're giving him a thumbs up, subscribing to the channel down below, because it's free to subscribe to this channel to get this update every week. But really what you should be doing is emailing Jim and getting his most recent technical review. So Jim, how do people do that?
Jim Welsh Macro at Gmail, and you get it. So as Blake noted, you can use your thumb. Don't use any other fingers. Okay.
Make sure you give him a thumbs up and jump down below. I mean, if you want to have a conversation with Jim, I know he checks the comments. So please,
and I respond to everyone.
All right.
And there's a number of people that show up frequently, and I appreciate their feedback. I have people that say, I think you're wrong, Jim. And it's great. I mean, that's what this is supposed to do.
What makes a market,
conversation.
Right?
Yeah,
makes a market.
Exactly.
Yeah. So, Jim, I want to thank you for being with us this week. I look forward to catching up with you next week, and hopefully the weather in your neck of the woods is cooling off as it is over here. So,
it is.
Good. Take care, and thank you everybody for listening in. Make sure you give Jim a big thumbs up, and we'll catch you next week here on Trader Summit.
Sounds good, Blake. Thank you.
Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.